lecture covers the remainder of Chapter 12 on land, capital markets, and innovation. So we've been talking about the input markets. We've talked about labor in Chapter 11. Earlier this week we talked about the market for land and physical capital. So today we're going to talk about some other markets for capital investment, and we will finish by talking about the market for the entrepreneur. An important source of capital for any firm is financial capital. So this is the actual money that a firm needs in order to purchase those physical capital inputs or to just run their daily operations. So firms will typically need to have tens of thousands or even hundreds of thousands of dollars in order to cover these costs. And often they don't have this money just laying around. And so there's a few different sources of obtaining financial capital. For a small business, they can go to a bank and obtain a small business loan. And the advantages of this are that it's very simple and rather straightforward. They just need to submit an application and go through the application process. They may also need to provide some collateral, which would just give the bank some safety in case the business is unable to repay that loan. However, the downside of going to a bank for financial capital is that you're somewhat limited in the amount of money that banks will lend to you. So if you need to borrow a substantial amount of money, going to a bank may not be your best option. So when we talk about large corporations, think General Motors or Microsoft, and if these companies need to raise a substantial amount of financial capital, they will likely do so by issuing bonds or by issuing shares of stock. So a bond is a debt instrument that promises to pay back a certain amount over some set period of time. A bond is really essentially just an IOU. So an investor would give the corporation some amount of money, let's say $5,000, and the corporation can use that money today to invest in new equipment or to cover operating costs. And the firm agrees to pay back this money at a maturity date in the future. So we have to talk about why any investor would be willing to do this. Well, there has to be some incentive in it for them. And the incentive is that the investor receives a financial return on that bond. So the company like Microsoft would pay the investor a coupon rate or a fixed payment for the use of that money over the length of the bond. So there is a return on the investment. Now, bonds are rated based on their riskiness by bond rating agencies. And just like with any financial asset, there's a trade-off between the level of risk and the return that you can expect to receive on this investment. So very safe bonds are rated AAA+, and they'll tend to pay a lower interest rate or coupon rate than junk bonds or bonds that are regarded as much more risky. Once a firm issues bonds and raises the financial capital, bonds are typically traded in the bond market. And this is where if a bondholder wants to liquidate this asset before the maturity date, they can actually sell it to another investor in the bond market. And so once we enter the bond market, we're no longer raising financial capital for that particular firm. We're just exchanging the asset between buyers and sellers in that market. Another option for firms is to issue stocks. So if a business would like to go public, that means to start selling stock, they will have an IPO or an initial public offering. And what a stock represents is a share of ownership in a company. And so if you own stock in a company, you are essentially a partial owner of that firm. So the benefit here for a firm is they can raise a large amount of financial capital by issuing stock. And this will give them the ability to reinvest that money into their business. The downside is that you give up a lot of the power over running the business. So shareholders will vote on a board of directors, and they'll have voting rights and profit sharing in your company. And just like bonds, once a firm issues stocks and has raised that financial capital, stocks can then be traded in the stock market. So when stocks are bought and sold in the stock market, they're no longer necessarily generating revenue for that company unless that company is holding stock in itself. Um, but that's based on the supply and demand within the stock market itself. Other possible sources of financial capital include venture capital, which is when um, there's an investment made in a startup company. So if somebody is willing to financially back this company, they're acting as a venture capitalist, and the return then is that they can share in the profit going forward. Private equity is another option. So this is typically targeted towards struggling firms, and the private equity firm will come in and provide a new strategy to hopefully turn the company around, and then they would get a share of that profit. Now let's talk about investment in human capital. Remember, human capital is the knowledge and skills of your workforce. We see a very strong relationship between education and earnings. As the level of education goes up, average lifetime earnings will also increase. So here you can see in the table that in every age group, as your level of education increases, the average earnings will increase as well. And I'm guessing that that potential for higher lifetime earnings is the reason that you are all here today in college. So that's the benefit, and this is a benefit that you're going to receive in the future. But you are experiencing some significant costs today by making this decision. You have the direct costs of tuition, and you also have the opportunity costs of the earnings you could have been making if you just went straight into the labor market. So if we look at this graph, we're comparing the costs and then benefits of those who pursue college versus those who stick with a high school degree only. So for those who enter the workforce straight out of high school at the age of 18, they're denoted by that red line, we can see that their earnings stay relatively flat and actually decrease as they get older. For those pursuing a college degree, the green line, we can see that initially from years 18 to 22, you are actually in the negative. So you are below zero, you're paying tuition, and you're also losing out on 4 years worth of additional earnings that you could have been making if you weren't spending your time in school. But the benefit is that you can expect to receive higher earnings throughout your lifetime. And this is substantiated in data year after year. And if we break the data down by gender, by race, we find that in every category, those with higher levels of education will, on average, earn more money than those with less education. So some points on our human capital theory. Again, this really comes down to a cost-benefit analysis. And so because younger people have a longer time to enjoy the benefits, they're more likely to invest in human capital. As the difference between earnings between high school and college grads increases, more people will attend college. And I think a great real-life example of this is if we think of past generations when it was actually, especially in this area, very easy to get a really good job straight out of high school. So you could work in the mills. You could even maybe go work for an automaker with just a high school degree and earn a very comfortable way of living by doing that. But now our economy has changed, and it's more difficult for those without advanced skills to find a job that will give them that sufficient standard of living. So as that difference between low-skilled workers and high-skilled workers' earnings has increased, more people are choosing to attend college. So now let's talk about why human capital leads to higher wages. Well, practically we can say that investment in human capital, increasing your skills and productivity, makes you more valuable to your employee, right? So you have these skills that are desired, and employers are willing to compensate you for that. Some economists also suggest that education serves as a signal that by getting a bachelor's degree, you are sending a signal to all of your potential employers that you are dedicated, that you are intelligent, that you have a strong work ethic. And so it's not even so much about the classes you have taken or the specific things you've learned in your classes. It's more about the fact that you just accomplished this really exceptional accomplishment, that you started something and finished it that did take a lot of sacrifice. And these are going to exemplify that you have these skills and traits that employers desire out of their employees. Another component of human capital investment that's very important is on-the-job training. So this is going to be training very specific to the actual work that you're going to be doing. It will often consist of supervisory training. They may send you to specialized classes as well. And so this specific training is going to make you much more productive within your specific field. General training, on the other hand, which you probably will have acquired throughout your time here in college, is going to prepare you for any career. So you work on your communication skills, you work on your interpersonal skills, you have some basic computer skills. So there's two different types of training. Specific on-the-job training is going to be increasing your skills that directly relate to your employer. Now let's talk about our last input, the entrepreneur. So entrepreneurship and innovation basically describes the ability to take inputs and turn them into valuable products and services. And there's a great deal of risk involved with this because there's no guarantee that you will be successful. So to incentivize entrepreneurs to take this risk, profits represent the payment that entrepreneurs receive by producing these products and assuming the risk of doing so. Profits also serve a really important function in our free market in that they direct entrepreneurs towards the types of goods and services that consumers want. So when you think about when the iPod first came out, so this was a portable MP3 player, that suggested that consumers wanted more of these high-tech gadgets. And so we saw dozens follow that. We now have phones that are capable of basically being our MP3 players and our high-quality cameras and our GPS devices. So by signaling to producers about what we want, entrepreneurs can funnel resources into those areas and away from the areas that consumers just don't seem to be too much interested in anymore. An important component of the entrepreneur is intellectual property rights. So these are sets of exclusive rights granted to the inventor or producer of some creative work, and it allows them to earn profits over some fixed period. So we talked about intellectual property rights in our Monopoly chapter, and we talked about how important they are in providing an incentive to innovate. If you can't be guaranteed some fixed time to earn profits on your investment, you're much less likely to innovate. Some types of intellectual property rights include patents, copyrights, trademarks, and industrial design rights. So all of these are very important in ensuring that entrepreneurs have the incentive to innovate, and countries that have clearly defined intellectual property rights that include legal enforcement are much more likely to have higher rates of innovation. That concludes our Chapter 12 lecture. We will have our quiz over Chapters 11 and 12 on Monday. Please let me know if you have any questions. Thank you.